football, the red zone is where a team has to make small adjustments to ensure victory. As you approach retirement, you also need to make small adjustments to ensure success. This is the Red Zone Retirement Program with registered investment advisor and enrolled agent John Mears of Mears Money Management.
All right, Coach, this week we've got an email question that had come in, and it's worthwhile to have this chat. I know you have these conversations often because a lot of people do find themselves in a boat where they're later in life and they're inheriting something from their parents who pass on or something like that. And it's a sticky widget because a lot of times people feel like, there's the emotional piece, and we're not going to touch on that very much. We're really going to just kind of focus on the taxation for this conversation based on this email, because a lot of people feel like, oh man, this is going to crush me in taxes. So let's talk about what it means, when you inherit a home, in this case, in this example, and some tax things to think about for dealing with that. So let me give a setup here for the email question, and then we'll get into it. First, how you doing? You doing all right?
Doing great. As we're recording this, we're just after the Super Bowl, and we're already getting ready for spring training for baseball. And it was weird. The headline is, I'm an Angels fan, and the big headline was the Angels have already been eliminated from the playoffs.
So it sounds like the Jets and the Mets on a regular basis. For sure. I think it was a Family Guy bit where they was talking about going to being a baseball fan, and it's like, we're so excited. It's like, I think it's opening day for the Mets, and it's like, here's the opening pitch and then boom, and it hit it and goes, and they've been eliminated.
That's it. My life. That's my reality.
The very first pitch. So, all right. Well, let's get into this question about taxation this week. All right. So here's the question. Lady says, my mom passed away a couple of years ago, and my three sisters and I inherited the house. I've always wanted to sell it. They are just now coming on board to the idea, but they are concerned about the tax implications. I lack the skill set to be able to explain to them why I don't think it's going to hurt us that bad from a tax standpoint. Can you help break down some things to think about? Yes. So let's talk about what happens when you get, an inheritance like that.
Yes. So this is a great question, and this is a typical question. I must get this once every couple months, to be honest with you.
Okay.
I deal with retirees, and a lot of times they're early retirees. So if you're 60-ish, your parents are 85 or 90-ish probably. And so this is what happens. The second parent has passed away, leaving a house. And people, the siblings inherit this, the children inherit this, and it can be complicated sometimes. It is complicated, yet on the same token, there's a lot of simplicity here. So first of all, I'm going to treat this situation as if mom just passed away, and then we'll go to the 3-year issue here.
Okay.
But one of the things that people kind of know but don't always know how it applies is you have a step up in basis. When somebody passes away, your basis, which is your cost when you're selling it, is whatever the value of that property was as of the date of death. So if mom died on July 1st, then whatever the property's worth on July 1st, that is your new step up in basis. If you turn around and sell it on July 2nd, your sale price and your cost basis are darn near the same thing. So you should have zero gain.
Yeah, let's give a little context to that, Coach, for people, right? So a lot of times, let's say mom, dad lived there for 40 years, right? And so, oh man, they paid $100,000 for this place 40 years ago. Now it's worth, we'll just go 500,000, maybe more than that. Right now it's worth 500,000. I'm going to get eat up in taxes. That's usually where the complication, the confusion starts. So what you're saying is that 100,000 mom and dad bought it for, that's no longer what the deal is. They're getting it for the 500,000, the value when mom died.
Correct. So the step up in basis is hugely important. Now, if you have a good tax guy, you actually can, if you sell the property, again, we'll call it immediately, we'll put that in air quotes, immediately after inheriting it, because it's not your primary residence, it is actually considered an income or investment property. You can actually get a small loss on your tax return, because when you sell, you actually have some closing costs, some realtors costs, whatever it may be.
Sure,
so out here in California, it is very normal for somebody to say, hey, my mom lived in Woodland Hills and her house is worth $1 million. That's very normal here in Southern California.
Okay.
And so off of $1 million, what are closing costs? 6 to 8%. I'm going to round all the way up to 10% here, just for simplicity here.
Yeah.
So if you had $1 million house and you sold it and had all these expenses, you have $100,000 possibly in losses divided up amongst you and your siblings. So it's possible that you would have amongst you and three sisters, amongst the four of you, each have a $25,000 loss on your tax return. Now, I'm not going to get into how you report that on your individual return because there's actually some other complications there as well about how you itemize and whatever. But the idea is that you could possibly have a loss to claim on your tax return. Most people don't care about that when they talk to me, though. Most people are just like, I don't have to pay any gain. No. Now, there's a presumption out there that if you sell this property within 9 months after the date of death, that whatever you sell it for is considered pretty much that is what the fair market value was on the date of death. Even if the market kind of goes up in that time period, the IRS will back off and say, it's not part of tax law, by the way. They can challenge this, but there's a presumption out there. If you sell within 9 months, you're okay. Now, in this instance here, where you guys have held on to the house for 3 years, we lose that presumption.
2 years, but yes. Okay.
So 2 years, 3 years, more than 9 months, whatever it may be.
But it should be easy enough, though, Coach, right? I mean, you could just kind of go look at what the fair market value was. I mean, especially with Zillow apps and things like that nowadays, you could get a ballpark, right?
You can have an idea. However, again, if you got audited, the IRS would want a little bit more than that. So what I recommend to clients is they hire an appraiser for the $400 or $500 that appraiser's going to, it's money well spent, in my opinion. Okay. Have the appraiser go back and do an estimate of what the fair market value was on the date of death. Any appraiser can do this. It's not very difficult.
Gotcha. Okay.
You just got to pay them to do it. They're not going to work for free. So there is money out of pocket. But to me, that is your reassurance if you ever got challenged by the IRS. So,
and that's the case, right? Like it's only if they audit you, but you don't want to go out there and fudge it because if you do, you could be opening yourself up. So why not just, to your point, spend the money, do it right, get it done? It's
money well spent to me. But there's people that won't do that or haven't done it, can't do it, whatever, they're arguing amongst the siblings are not willing to do that. But you can go back and probably have a pretty good estimate. But again, it's a little bit more difficult to do that. But yeah, on Zillow, they have that little graph that shows what the value is. And you can kind of go back to that. And that's better than nothing, if you will.
So we'll play devil's advocate here. So for these folks, right? So they didn't really tell us the specifics, but it's been 2 years, right? So let's just assume that for the sake of the argument, the house appreciated $100,000. Let's just make it simple. Would that be capital gains then? Is that how that would be taxed?
Yeah, so at that point it becomes capital gains. So you're looking at, and when you inherit property, it's going to be capital gains. There's never going to be an ordinary income issue here. So it's always going to be capital gains, even if you sell it within 3 months or 6 months. It's going to be capital gains rates. So that's kind of helpful here. So you're going to pay a gain on that growth, if you will, from $1 million to $1.1 million. But again, you have closing costs. So that will kind of reduce your gain down to something possibly more reasonable. But that is something you always want to be aware of, is once you get past that 9 months, a year or whatever, once you start selling 2 or 3 years down the road, there's a very possible likelihood that you're going to have some sort of a capital gain that you're going to have to report on your tax return. So that's something to be aware of. Now, depending on how the estate was set up, whether it's put in a trust or whether you're just selling the house outright outside of a trust through probate, whatever you want to call it, the escrow company will then kind of go through how this is going to be divvied up between you and your 3 siblings and so forth. If you had
for the sake of the argument, probably 25 apiece, right? And so that also cuts that tax liability as well, right? So even if it was $100,000 capital gains, probably 15%, right, on the capital gains.
Yeah, so you're looking at roughly 15%. Now, I've had this, we run into this with siblings all the time. Every sibling has their own unique facts and circumstances on their own tax return. Okay. So we don't know what their capital gain is going to be. So we start with a rough rule of thumb of 15%, but as we all know, that can get as high as 22.5%. And then California does not have a capital gains rate. It's only ordinary income. So if you're looking at 15% plus Gavin Newsom wants 9.3%, you're looking at 25% right off the bat. And so I always tell people, just kind of hold back that amount. If you have $100,000 that you're going to have in a gain, kind of keep $25,000 or $30,000 in a CD that you can pay next year. Whether or not you need to pay any estimated taxes, rarely do you have to do that, but it's possible. And again, that's up to you and your tax preparer, whether that's a need, but at least have that money set aside, because you don't want next April to come around and be caught holding the bag for a very large tax bill. So that's something to be aware of. So
it sounds like this person was kind of accurate. Like he or she, we're not sure, feels as though that it's, may not be that big a deal. And it sounds like, depending on several factors, do you find that the case oftentimes more than not, that because of that step up in basis, it obviously helps out. And I guess we should point this out, Coach. Thankfully, Mom did leave this after she died, because had she have given it to one of them before she died, that ends that. Right?
Correct. So this is another reason why if you were added, now this can get very complicated here, but if you're added to the deed before mom dies, that's also an issue where you become a joint tenant. But let's just say mom gifted the property to the four siblings. Yeah, your cost basis is her original purchase price.
Now you're on the hook
you have
for
a
the whole
large
thing.
gain, and you can't get out of it.
Yeah.
So there's a question that I get oftentimes is if mom adds you to the deed. It gets a little complicated here, and you should seek your own tax advisor on this. But if you were not one of the original purchasers of the property,
yeah,
and you have not contributed anything to the property, you can actually enjoy the step up in basis. So it's unique there. You should talk to a lawyer, but you're okay if you were not part of the ongoing, purchase of the property, paying for improvements, paying for the mortgage, all that stuff up until the date of death. If you're just basically added simply to the deed, you shouldn't have to worry about it. But again, talk to your own attorney, talk to your own tax advisor about that. But that I believe that's how I've done it, and that's how what my research.
And it's I talk to advisors all across the country, and typically it's like usually. That's a conversation sometimes that older folks will have. They'll say, hey, I'm thinking about putting one of my kids on the property so that, the nursing home can't get it, or all this kind of stuff, and different kinds of ideas. And most advisors say, look, unless it's really, really, typically the answer is no. All right. Ideally, this is not a good idea, because then you open up a whole can of worms. If you're still around and you put one of your kids on and they get a divorce, now that's an asset that the other person could go
or you get
after,
sued,
or you get sued, right? You lose the step up in basis. So there's just a lot of reasons to not, to just leave it and pass it on after death.
Yes.
Right.
But
so
we usually find out after the fact. So we usually find out, oh, by the way, my mom died, but I was already on title. Okay. Yeah. So we
right.
What's the old saying? We're always the last to know.
Sure.
So but when people come to me and say, should we be added? I always say, be very, very careful.
Yeah.
Do my best, Willis. I wouldn't do that. You know what? I wouldn't do that stuff if I were you. That's be very careful about that. But for what we're talking about here with this listener here about how to handle this, there shouldn't be a big problem. Now, I'm going to add another little wrinkle here before we conclude, and that is, what if they inherited it and they rented it out for the last 2 or 3 years? Well, now you have another can of worms here. And this is why I personally believe in selling the property as quickly as possible after inheriting it, unless one of you is going to move into that property. Because if you decide to rent it out, now, first of all, you obviously have additional tax issues while you're renting out the house, but now you have depreciation. You're going to have depreciation recapture. You're going to have different types of, not just capital gain. You're going to have ordinary income. You're going to have a whole bunch of other things. So this is why that complication, especially if you're in your 60s and you're near retirement or at retirement age, do you really need that complication of mom's house or mom's property to kind of just muddy the waters? You can sell the property, take the money and run and be okay. I'm sure mom and dad would be totally fine with you guys, using that money for, a prudent reason and purpose, but being okay with you selling the property at that point in time. So this is something that, again, you mentioned at the very top that there might be some sentimental reasons. We should probably try and go through that briefly, and that is that people do sometimes hang on to things.
And it sounds like that was probably the case, right? Because it said it took a while for some of the sisters to come around to selling it. And I think, John, this is the importance of maybe mom and dad getting this stuff kind of laid out and working with the kids before they pass. To your point, the faster they can offload it, if that's, then go for it. Because there's so many things, like if you have multiple kids, somebody wants it, somebody doesn't want it. This is delay in time. Who's taking care of it? Who's keeping the maintenance up? There's like all those things start to kind of factor in, right?
Yep. Absolutely. Yeah. So this is something that is a conversation that needs to be had, like you said, before the last parent. Yeah. Ideally, that is something you want to bring up. My own sister is having a challenge right now trying to, sell a property that she and her husband inherited, because there's other complications that can exist out there. They're trying to sell it and they're having difficulty, but I think that, but there's also other siblings involved there as well. And so they're all on the same page, but sometimes it just doesn't happen quickly. And there's, and they've all brought that up. So it's not easy. It's harder than, again, it's more complicated than people sometimes realize. But then again, there's a lot of simplicity as well. If you can sell it quickly, you're gonna do well, and you have the opportunity to get cash tax free that can help you in your retirement. And
Okay.
it's a great opportunity.
So fundamentally, the big takeaway from this is the step up in basis being hugely important, right? Understanding that you're going to get it for that new value. So, again, even if mom's value was worth $1 million and you waited 2 years and it's worth $1.1 million when you go to sell it, even then the tax, penalty may not be that bad because of some of the things you mentioned, like the selling costs and all that kind of stuff. So it's important to talk with somebody on this, obviously, tax situation, have a conversation, talk with a financial advisor, possibly an attorney or a CPA, whatever the case is, but sooner than later.
Sooner the better. Yeah.
Mm-hmm. But hopefully that helps out with the question. Thank you so much for listening. And if you got questions like that, as John said, he probably answers something like this probably once a month. So a lot of people are in that same boat. Reach out to him, have a conversation, try to get some of those ducks in a row before these things come down the pike. And that can certainly make things a little bit more efficient and easy along the way. You can find the links in the show descriptions below. Book a chat with John.net or go to mearsmoney.com, either one, whatever works for you. And get some time onto the calendar. And don't forget to subscribe to us on Apple, Spotify, and right here on YouTube. And leave us a comment down below if there's something we missed or John missed you want to talk about, you want us to talk about. Let us know. We'll dive in and tackle it, right? So anything else, Coach?
No, that was a great question, and I love these types of questions. So keep bringing them in, people. We like I get lonely, and I need to talk about this stuff. So.
He's got to talk about this stuff. So good stuff. Thank you so much for the question. We appreciate your time as always. We'll see you next time here on Red Zone Retirement Program, Simple Investing, Smart Future with Coach John Mears. John has a couple of free books, Diffuse and Tax-Free Retirement in California, that reveal exactly how you can experience zero taxes in retirement and overcome the IRS lien on your 401k, IRA, and 403b, which could threaten your future lifestyle. These are complimentary, so all you have to do to pick these up 100% free is just stop by RescueMyRetirement.net. That's RescueMyRetirement.net. Fill in the basic info and he'll ship those out to you immediately. That's RescueMyRetirement.net for a copy of Diffuse and Tax-Free Retirement in California.
Advisory services offered through Mears Money Management, Inc., an RIA registered in the states of California and Texas. California Department of Insurance License number 0685203.